Imagine stepping into, well, the places where the future is literally being designed and built. Think towering cityscapes, groundbreaking products, even the visual magic in your favorite films. Today, we're aiming to give you a kind of direct line to understanding a really crucial player in that whole innovative world. We're taking a deep dive into Autodesk Inc. That's NASDAQ, KT, ADSK. They're a global leader in software that helps architects, engineers, construction teams, product designers, manufacturers, and even media pros bring ideas to life. And our insights today, they come from a pretty recent, very in-depth equity research analysis done by a senior equity research analyst. It's dated August 25, 2025. So hot off the press. This report gives a really comprehensive look at Autodesk's strategy, its financial health, and where it sits competitively. Our mission here is simple. Distill the core drivers behind Autodesk's performance, look at the opportunities, understand the risks, and they are significant, and basically give you a clear, balanced view. Without getting totally bogged down in jargon, you should walk away with the really important nuggets from this detailed analysis. So, are you ready to discover what makes this company such an industry standard and maybe where its future is heading? Okay, let's unpack this. All right, let's start with the basics. For anyone maybe less familiar, you might recognize a product like AutoCAD. It's pretty much synonymous with design software, right?
Oh, absolutely. AutoCAD is iconic, but Autodesk is much bigger than just that one product. It's really the foundational software for what we call the design and make process. That spans huge industries. Architecture, engineering, and construction AEC, product design and manufacturing, or PD&M, and media and entertainment, M&E. Basically, their tools are, well, indispensable for creating everything from massive infrastructure projects like skyscrapers to, the complex special effects in movies. But what's truly fascinating, I think, is the massive strategic shift they've pulled off in recent years.
Yeah, the report really highlights that. It calls it a successful transition to a subscription-based model. Now, this wasn't just a small change, was it? How big a deal was this shift?
Oh, it was fundamental, not a minor tweak at all. It completely re-engineered their entire business model, and it radically reshaped their financial profile. The report says something like 97% of their revenue now comes from subscriptions.
97%. Wow.
Yeah, and this isn't just about how customers pay. It creates this exceptionally predictable, recurring cash flow stream. That means immense financial stability. It gives them resilience. They can invest heavily in R&D, even through market downturns, potentially widening their lead when maybe competitors have to pull back.
Right.
It fundamentally shifts them away from just one-off sales towards these ongoing, deeply embedded customer relationships.
So, okay, for the user, it's a regular fee, not that huge upfront cost.
Yeah.
But beyond that predictability you mentioned, what does this model really mean for Autodesk's long-term financial health from an investor's viewpoint?
Well, it significantly insulates them from the kind of quarter-to-quarter volatility that can really plague companies with more transactional, license-based models. And that predictability, it's highly, highly valued by investors. It gives excellent visibility into future cash flows, allows for much more reliable strategic planning, and, reduces uncertainty.
Okay, so strong model, predictable revenue. You'd kind of expect the stock to be flying high, right? But the report points out its year-to-date performance has been, quote, relatively flat, lagging the broader market. Now that's interesting. What's going on there? What's the disconnect?
That's exactly the paradox the report digs into, because operationally, Autodesk is performing extremely well. Exceptionally well, actually. So, for example, if we look at their most recent earnings, Q1 of fiscal 26, ending April 30th, 2025, total net revenues hit $1.63 billion. That's a robust 15% increase year over year.
15%, yeah. Solid.
Very solid. And they reported impressive operating margins, too. GAAP was 22%, non-GAAP hit 37%.
37, wow.
And adjusted earnings per share, $2.29. Comfortably beat analyst estimates. So these aren't just like okay numbers. They show a business that's really firing on all cylinders.
Those are impressive numbers. So breaking it down, where's this growth actually coming from? Which parts of the business are driving it?
Well, the AEC segment, architecture, engineering, construction, that continues to be a primary engine. Sales there jumped 20% year over year to $809 million.
20% in AEC, okay.
Manufacturing also showed real strength, up 23% to $179 million. And even the enduring AutoCAD and AutoCAD LT family, which some might think of as mature products, even they grew sales by 14% to $1.36 billion. So it's pretty broad-based strength.
And it's not just the money coming in now, right? How solid does their future revenue pipeline look?
Extremely solid. The report highlights strong billings. That's a key leading indicator for future revenue, right?
Right.
Billings surged 29% in Q1 to $1.43 billion. That's a big jump.
29%, wow.
And on top of that, their remaining performance obligations, or RPO, basically contracted future revenue.
Money already committed by customers.
Exactly. That increased 14% to a massive $6.94 billion. That's a huge backlog, provides excellent visibility, and it's a huge vote of confidence from their customer base.
Okay, and the customers themselves, are they sticking around? Are they maybe spending more over time?
Yeah, absolutely. The net revenue retention rate, that's a crucial metric. It shows if they're keeping customers and successfully upselling them.
Right, getting them to buy more or upgrade.
Precisely. That rate has consistently stayed within their target range of 100% to 110%. So they're keeping customers and growing the value of those customers. And total subscriptions grew too, up to 7.79 million. That's an increase of about 516,000 from the prior year. So all these metrics together, they paint a picture of a really healthy, engaged, and growing customer base. That's the bedrock of their whole financial model.
Okay, so with all those strong fundamentals laid out,
Yeah.
what's the compelling long-term bull case? Why are so many analysts still saying, moderate buy or even strong buy, despite that flat stock performance we talked about?
Well, the long-term bull case is it's genuinely compelling. It's rooted in several key drivers. First, their whole strategic evolution has turned them into this globally diversified player. They're deepening penetration in markets they're already in, and they're expanding their product offerings. And there's a unique near-term catalyst the report mentions, this strategic crackdown on non-compliant license usage.
Ah, right, going after pirated software users.
Essentially, yes. Converting users of, let's say, unauthorized software into paying subscribers. It's a direct path to adding potentially high-margin revenue growth.
That's definitely an interesting way to boost the top line. But beyond enforcement, what about innovation? How are they keeping their actual products ahead of the curve?
That's the second major driver, and it's absolutely critical. Cloud-based platforms are central here. Think Autodesk Construction Cloud or the Fusion platform for product design and manufacturing. These enable seamless collaboration, which is huge for their customers. And crucially, Autodesk is aggressively integrating generative AI and machine learning across its entire product suite.
AI in design software. How does that actually work? I mean, is it just making things faster, or is it enabling totally new ways of designing things?
It's really both, and that's what's so exciting about it. So you have tools like auto-constrain in Fusion. That uses AI to automate a lot of the tedious, repetitive design tasks.
Okay, freeing up the humans.
Exactly. Frees up engineers and designers to focus on the higher value, more creative work. But beyond just efficiency, AI is starting to enable things like generative design. That's where the software itself can actually propose optimal designs based on parameters you set.
Wow.
Yeah. So this push into AI isn't just about adding cool features. It's expected to be a major driver of productivity for their customers. And for Autodesk, it's a key source of competitive differentiation and, looking ahead, future pricing power. It kind of redefines what's possible in the design space.
So AI makes their customers better, which in turn makes Autodesk stronger. Okay. And then the report talks about this generational moat. That sounds incredibly strong, almost impenetrable, isn't it really? Or could something disrupt that?
Well, impenetrable is a strong word, but this generational moat is probably their most durable competitive advantage. It's not just that Autodesk software is popular, it's literally the industry standard. It's taught in universities all over the world.
Right, so engineers and architects learn on it from day one.
Precisely. And that creates incredibly high switching costs. It's exceptionally difficult and, frankly, costly for customers to rip out Autodesk and move to a competitor once they're embedded in that ecosystem. Now, is any moat truly impenetrable? Probably not forever. But you add in the massive user base, the huge ecosystem of third-party developers creating add-ons, the training centers, the service providers, it all creates this formidable barrier to entry. It means Autodesk is just deeply, deeply entrenched in these critical global trends, digitization, sustainability, and how things are designed and manufactured.
Okay, that bull case is definitely compelling, robust even.
Right.
But the market isn't totally buying it yet, right, given that flat stock performance. So what are the headwinds? What are the material risks the report points to? What's the catch?
The primary concern, the one that really stands out in the report, is valuation, plain and simple. As of August 2025, Autodesk's trailing 12-month price-to-earnings ratio, TTM-PE, is hovering around 61x.
61. Okay, that sounds high. Put that in context for us.
It is high. especially if you compare it to the broader software industry average or even its direct competitors.
Yeah.
You mentioned Dassault Systems. They're around 40x. PTC Inc. is maybe 50x?
It's significantly higher.
Significantly. Now, to be fair, Autodesk is delivering superior growth. That 15% year-over-year revenue growth we talked about, that outpaces its peers. But a 61x PE implies the market has incredibly high expectations baked in for future earnings growth. Extremely high.
Leaves no room for error.
Exactly. Leaves very little margin for error. And it creates a significant risk of what's called multiple compression.
A multiple compression. Break that down for us. What does that mean in practical terms if you own the stock?
It basically means that if Autodesk doesn't meet those really elevated expectations, even if its earnings still grow, just maybe not as fast as hoped, the market might decide it won't pay as high a price for each dollar of those earnings anymore. The multiple, the PE ratio, compresses or shrinks. And even with growing earnings, the stock price can fall. Essentially, yeah, it's priced for near perfection.
Price for perfection. Got it.
Mhm.
What other risks are lurking out there?
Well, a big near-term risk is just their exposure to the business cycle. Their end markets, AEC, manufacturing, are highly sensitive to the overall global economy.
Right. Construction slows down in a recession, manufacturing too.
Precisely. So an economic slowdown or a recession would almost certainly reduce demand for their products and services. Now, the subscription model provides some buffer compared to the old license model.
Smooth things out a bit.
It does smooth things out, but a prolonged downturn would eventually hit their billings and their revenue growth. You can't completely escape macroeconomics.
Makes sense. And competition. We talked about that moat, but are there serious rivals trying to chip away at it?
Oh, absolutely. The moat is strong, but it's not undefended. Autodesk faces intense competition from other large, well-capitalized players like Dassault Systems, like PTC. Plus, there are numerous smaller, more specialized software providers focusing on niche areas. So Autodesk has to constantly innovate just to maintain its edge. And there's always the risk, I suppose, that some more nimble competitors could offer lower-cost solutions, maybe targeted at specific market segments, peeling off users who don't need the full, robust Autodesk suite.
Okay. And what about that license compliance crackdown we talked about, converting the pirates? Could that potentially backfire?
That's a really important question, and it's something the report explicitly flags as a risk. While it's definitely a revenue opportunity, the report warns that, quote, an overly aggressive approach could create negative sentiment among its user base.
Okay. Push too hard and you alienate people.
Exactly. Balancing that drive for revenue generation with maintaining customer goodwill, maintaining a positive brand perception. It's a very delicate act. You don't want to alienate a segment of users, even if they were non-compliant, because that negative sentiment could potentially ripple through the broader design community.
Right. So pulling this all together, what does it mean for someone trying to understand Autodesk right now? Is it this unstoppable growth juggernaut?
Yeah.
Or is it more like a high wire act where flawless execution is absolutely critical?
Well, it's probably a bit of both, isn't it? The report really offers a balanced perspective. It clearly describes Autodesk as a high-quality, wide-moat software company. It's got strong secular growth tailwinds behind it, but its current valuation already reflects a lot of that optimism. Much of the good news seems priced in. If you look at Wall Street consensus, it generally leans towards moderate buy or strong buy. The average 12-month price target cited is around $342. But, and this is important, there's a really wide range in those analyst targets, from maybe $270 on the low end up to $430 on the high end.
That's a big spread.
It is, and that spread really reflects those differing views among analysts. How much weight do you give the near-term macro headwinds versus the compelling long-term growth story?
Okay, so if you're watching Autodesk, trying to gauge its health and direction, what are the absolute key things to monitor? What signals should you look for?
The report suggests keeping a close eye on a few crucial indicators. First, billings growth. That's probably the best leading indicator of future revenue. Any significant slowdown there would be a definite red flag.
Billings first. Got it.
Second, watch the net revenue retention rate. If that starts consistently dipping below that 100% to 110% target range, it could signal increasing customer churn or maybe a slowdown in upselling. Either way, not great.
Okay, NRR.
Third, keep an eye on AEC segment performance. It's not just their largest segment, it's also been the fastest growing. So its health is critical to the overall story. And finally, really pay close attention to management commentary on the macro environment. Listen to what they say in earnings calls about the economy and, crucially, their forward-looking guidance. That gives you invaluable context.
Great pointers. Okay, so we've really dug into Autodesk today. We explored that incredible transformation to subscriptions, the robust financial performance,
the exciting potential in cloud and AI, and that really formidable competitive moat. But we've also looked honestly at the risks, particularly that premium valuation and its sensitivity to the economy. Autodesk is sitting right at the intersection of these huge global trends, digitization, sustainability. It plays this indispensable role in how our world gets designed and built. But given that high valuation and the balancing act between driving aggressive growth, navigating economic cycles, and keeping customers happy with things like license compliance, which path will Autodesk prioritize? Will innovation, especially in AI, be enough to justify the premium? Or will macro headwinds force them to be more cautious? That's maybe the core question for you, the listener, to mull over as you think about the future of design engineering in this pivotal company.